Silver's trading at $62 an ounce this morning. In January, it hit $121. That's half its value. Gone in 6 months.
From Trek for Wealth, this is the podcast. I'm Avery.
I'm Grant.
Today, the silver mania that came and went, and the 46-year-old story that already told us how this ends. It just had the wildest 7 months of its entire trading history, an all-time record high, then one of the worst crashes ever recorded. And weirdly, Grant, none of this is new.
Nope. We've seen this exact chart before. Different decade, same ending. Let's get into it.
Where does this actually start?
1979. Two brothers from Texas, Nelson Bunker Hunt and William Herbert Hunt, decide silver is the answer to everything they're scared of. Inflation, a shaky dollar, a government they don't trust.
Reasonable fears for the era. 1979, you've got double-digit inflation, an energy crisis, everybody's savings getting quietly eaten alive. I get why buy something you can hold in your hand sounded like sanity.
Very reasonable fears. Their solution was a lot less reasonable. Silver was trading around $6 an ounce in January of '79. The Hunts, with some Saudi investors along for the ride, started buying. And not futures contracts they'd cash out later, physical bars. They chartered airplanes to fly it to vaults in Switzerland.
They were taking the silver off the market for good.
Every ounce they took delivery on was an ounce nobody else could ever buy. By late 1979, estimates put their stash at somewhere between a third and half of the entire world's tradable silver supply.
That's not investing. That's cornering a market.
That was very much the accusation. And for a while, it worked. Silver went from $6 to $17 to $30. And on January 18, 1980, it touched an all-time high of $48.70.
In 1 year, silver going from $6 to almost $49? That's not a rally. That's a rocket.
In 1 year. Jewelers panicked. Tiffany's took out a full-page ad in the New York Times, basically begging the Hunts to stop. Hospitals struggled to afford silver-based X-ray film. Families were melting down grandma's silverware just to sell it.
So regular people were feeling this too, not just Wall Street.
That's the part everyone forgets. And then, the referees changed the rules. On January 7, 1980, the exchange, COMEX, introduced something called Silver Rule 7. It restricted trading to liquidation only. You could sell, you could not buy.
The exchange just turned off the buy button.
Essentially, yes. Demand evaporated overnight. And the Hunts weren't just holding silver, they'd borrowed heavily against it. As the price started sliding, the margin calls started landing. Calls for more cash immediately just to keep their positions open.
And did they have it? Because at some point, "we're the richest family in Texas" stops being a real answer to a margin call.
Less and less of it. On March 27, 1980, a day Wall Street still calls Silver Thursday, the price collapsed. $21.62 to $10.80 in one single session.
50% gone in a day.
The Hunts owed billions they didn't have. It took an emergency loan from a consortium of banks just to keep the whole financial system from seizing up behind them. Nelson Bunker Hunt eventually filed for bankruptcy in 1988 and was banned from commodities trading for life. So, the history of a silver squeeze is really the history of what happens the moment the people who write the rules realize they're about to lose.
Okay, so 46 years later.
46 years later, and it's eerily familiar. Silver started 2025 around $30 an ounce. By late January of this year, it had rocketed past 100, an honest-to-God, never-before-seen all-time high of $121.64.
4 times its price in about a year. That's basically the Hunt brothers' exact trajectory, just compressed and with a lot more people along for the ride this time. Anyone with a brokerage app instead of 2 guys and a fleet of Boeing 707s.
Same week, gold hit its own record, $5,594 an ounce. Both metals absolutely on fire. And then?
And then the floor came out.
This time, the trigger wasn't a Hunt Brothers-style corner. It was politics. President Trump nominated Kevin Warsh, we covered this back in episode 21, to be the next Fed chair. That nomination spooked the market. The very next session, gold logged its sharpest one-day drop since 1983. Silver was worse. Spot silver plunged 27% in a single session, its worst daily fall ever recorded.
Worse than Silver Thursday?
By percentage, in that one session, yes. And then, just like 1980, the exchange stepped back in. CME Group, the modern COMEX, raised margin requirements, made it more expensive to hold a leveraged position, which forced even more selling.
So the rule change didn't cause the crash exactly. It just made sure nobody could hold on through it.
That's exactly it. By early February, silver was down near $79. By mid-March, it was hovering around $78. This morning, $62 and change. From the January peak to today, silver has lost more than half its value.
So is silver broken the way it was in 1980?
Here's where it's genuinely different this time. It's not 2 guys in Texas cornering the market. There's a real structural supply problem underneath all of this. Silver's in solar panels, EV batteries, AI data center hardware. The world has consumed more silver than it's mined for 5 straight years running. Cumulative deficit over 800 million ounces.
So the fundamentals didn't crash, just the price did. Which, honestly, might be the single most important sentence in this whole episode. Because most people hear silver crashed and assume the whole story was fake. It wasn't. The mania on top of it was fake. Those are 2 different things.
That's the tension in the room right now, yeah.
Okay, let's actually do the both sides here, because some of our listeners bought silver in December or January, and some of them are furious right now.
Fair. Let's do it straight. The bull case. Real structural deficit, real industrial demand that isn't going anywhere, a dollar that's been under pressure, a Fed under new, more politically pressured leadership. Some serious institutions, Deutsche Bank, JP Morgan among them, still see this rally as fundamentally intact, just violently corrected.
And the skeptic case?
The skeptic case is leverage lies. A lot of that January run wasn't people buying silver bars for their basement. It was speculative money piling into futures contracts with borrowed capital, chasing a number that was going up. That kind of buying doesn't reflect real demand. It reflects momentum. And momentum reverses violently every single time the moment the exchange or the Fed or reality steps in.
So which is it?
Both, honestly. There's a real supply story underneath, and there was also a genuine speculative mania sitting right on top of it. The mania popped. The supply story didn't.
So somewhere out there is someone who bought silver in January because everyone online said it was going to 200. And they're the ones who actually lost the money nobody else really did.
That's the same story every single time. The corner boys walk away with a bankruptcy filing and a book deal. The last people in are the ones left holding the bag.
Every mania has a Hunt brothers. Every crash has somebody who bought at exactly the wrong moment. Okay, so what do we actually do with this?
All right, 5 wealth moves. Whether you own an ounce of silver or you've never thought about it in your life. Move 1. If you own precious metals, or you're thinking about it, cap it like you'd cap a single stock. 5 to 10% of a portfolio max. It's insurance, not a strategy on its own.
Move 2. Never buy it on leverage. If you can't just hold physical metal or an unleveraged ETF and let it sit through a 40% swing without blinking, you don't actually own the exposure. You own a bet with a landlord who can call it whenever they want. That's exactly what turned a bad week for the Hunts into total bankruptcy. It wasn't the price drop that killed them, it was the borrowed money sitting underneath it.
Move 3. And this is the Hunt brothers lesson exactly. Watch for the rule change. When the exchange itself starts raising margin requirements or restricting trading, that's usually not the buying signal. That's usually the people running the casino just noticed the math doesn't work signal.
Move 4. Don't chase the parabola. If a chart's gone nearly straight up for months, the odds that you're the one who gets out at the top are basically zero. Somebody always is, but statistically, it isn't you or me. Dollar cost average in on the way up, the same discipline we talked about back in episode 17 with Buy the Dip. Don't jump in on the euphoria at the peak just because your group chat is suddenly full of silver charts.
And move 5. Separate the story from the price. Silver's industrial demand story is real. That doesn't mean silver at 120 was a good price. A great underlying trend and a terrible entry point can absolutely both be true at once. Same lesson from episode 30 with the AI chip sell-off. Same one from episode 29 with the SpaceX IPO. 46 years ago, two brothers with more money than sense nearly broke the entire silver market. And when the dust settled, it wasn't the Hunts who got hurt worst. It was the doctor who couldn't afford X-ray film, and the family who melted down their silverware to make rent. Today, it's not two guys in Texas. It's an algorithm, a headline, and 100,000 people piling into the same trade on their phones. Same ending, different decade. The metal never really changes. Neither does the story around it. Preparing without predicting. Always.
That's Trek for Wealth. Keep trekking.